Hi, Albert Liu here, inviting you to join me and Rick Rule at the 2022 New Orleans Investment Conference, October 12th through 15th. Link in the description below. Welcome to the Power Market Report. I'm Albert Liu. Today I'm joined by Brien, Lundin, CEO of the New Orleans Investment Conference, and Mike Larson, VP and Editor-in-Chief at the MoneyShow. Gentlemen, good to see you. How are you?
Doing great, Albert.
Doing well, Albert. Doing well.
Good to see both of you. Brien, we just, on the pre-roll, did a little bit for the New Orleans Investment Conference next week, so might as well ask you about it right now. What's it like running a conference without a pandemic or hurricane to contend with, for starters?
It's wonderful. I mean, isn't it crazy? The last couple of years, global pandemic, a hurricane, and the vestiges of the pandemic. We fit last year's conference in the trough between two waves, between Delta and Omicron. So it was a small miracle that we were able to have it, but it was a great event. However, last year we didn't have very many exhibitors that could come. This year we've got really a lot of attendees, a lot of exhibitors. It's going to be, I think, the real homecoming of the New Orleans conference this year, and great lineup. You'll be there, Mike will be there, I'll be there, and hundreds of other investors and speakers and exhibiting companies. It's going to be it's going to be a blockbuster, I think, this year. I think that the attendance looks like it's going to be our best in many years. And I think that's testimony to what that event brings, but also, the times that we're in and how important it is for people to really educate themselves and figure out what to do these days.
Yeah, the conference has always been important, but I'm getting the feeling that maybe this year and the next couple of years, you might be more important than you kind of dreamed or wanted, with inflation the way it is, heading toward double digits. In fact, if you use a historic measure, we are double digits. This is actually very, very important now, and I think it's on the minds of many. And the three of us were together in Boca Raton for Rick Rule's conference just a few months ago, and this is something I've noticed at your conference for several years, Brien, but this was the first year at Rick's conference I noticed a lot of fresh faces, young people. People are really getting onto this now, probably because it's in the news, probably in part because of the attention that crypto has put on alternative forms of money. But what are your thoughts about just sort of the importance of this event today, given what's going on?
Well, it every year, because I do have some marketing in my blood, as it were, I always say this one is the most important in years, and I genuinely feel that way every year. But it just seems to get more and more so. We are living in what I think is the end game of a 40, even 60-year trend of ever easier money by central banks, primarily by the Fed, by government coming in and creating more accommodative conditions whenever there is any kind of a hiccup in the economy. And that has resulted in a 40-year bull market in bonds, ever lower interest rates, rollicking bull markets in equities and housing prices. Generally speaking, a lot of bubbles that have burst and then been reinflated. So I think we're in the end games of this trend. I think things are happening more quickly now. And that's part of the reason why it seems like the last few years it's grown in importance that people get together and figure out what's going on. And I agree with the youth movement that we're seeing. A lot of the speakers we're featuring now are people who have made their mark on social media and financial Twitter and the like. And I think that makes it accessible to these ideas and principles accessible to a younger audience. It's great to see. It really is. And it's something I've noticed for the past, I guess, 5 or 6 years at the New Orleans conference.
You mentioned social media, Brien. I don't do a lot of Twitter, but when I do log on, I follow both of you guys. And I want to go to Mike, because you tweeted something this morning about, I think it was the mortgage applications or mortgage rates. Rise for the 7th week to the highest in 16 years. And actually they could go much higher than this. So we have the 30-year fixed at 6.75, which is high based on recent history. But that thing could go much higher, right? I mean, we've all been long enough to know that thing can go much higher. So, what are your thoughts on housing right now? What perhaps is in store for us there?
Sure. Well, as Brien alluded to, I mean, we've been in this regime for a few decades now of ever lower interest rates, ever rising debt loads, and that's really at all levels. That's government, that's corporate, that's consumer, and so on. And at the same time, the actual cost of servicing debt has generally gone down because interest rates have fallen, right? So even though you've added more debt, you've been amortizing that debt against a lower and lower interest rate. So payments have gone up or stabilized as opposed to soaring, or gone down, or stabilized as opposed to soaring. Now you have extremely high asset prices, and by asset prices you could say anything from stocks to homes to collectibles and more. But interest rates have been shocked higher. I mean, it was only how many months ago, a year and a half ago or so, when Jay Powell, chairman of the Fed, was saying, "I'm not even thinking about raising interest rates." And then so far this year, rates have gone from virtually nothing. They've gone up 300 plus basis points. So that's a huge move in a relatively short period of time. This is one of the most aggressive catch-up cycles, hiking cycles we've seen from the Fed, again, in decades, going all the way back to early 1980s. And as a result, you're shocking the housing market. You're shocking people who, if they had adjustable rate mortgages, they're in real trouble. But if you have somebody that, thought a year and a half ago, hey, maybe I might want to go out and buy a house, and let's say the house was priced at $400,000 or $500,000, and now they put it off for whatever reason, now they're going to go back out and try and buy a $400,000 or $500,000 house, and instead of having a 3.5% mortgage rate, it's going to cost 6.5%, 7%. I mean, that the payment impact is enormous when that happens. So what I think you're already seeing, especially in some of the hottest, least affordable housing markets, is noticeable cooling. You're going to continue to see that as time moves on, unless and until we get some renewed collapse in interest rates, and there's really no reason to expect that. So again, whether you're talking housing, whether you're talking about other forms of real estate, or even the stock market, the reason there's so much pressure on asset values is that we're no longer in this zero interest rate forever, negative interest rate forever environment that I think all of Wall Street and all of the real estate industry and other businesses were certainly getting accustomed to.
Every story, maybe I'm exaggerating, but many stories about this market start with but this is not 2008. They always kind of lay out the bad news, and then right away they put out, this is not 2008, which it's not. But is it similar? Guys, what do you think?
Well,
I mean,
I guess, when I look at housing, for example, I mean, housing and all the junk mortgages and everything being made, and the fallout from all of the securitization of all that garbage paper, that caused a widespread financial calamity, as we all know, in 2008. And housing was at the center of that crisis, right? The driving factor. This time, it's been more of a generalized asset inflation where housing's been swept up, but we haven't had all the stupid subprime mortgage lending. We haven't had all the sort of funny money mortgages that made housing the center of the last crisis. It's more tangential here. It's more money chasing yield, driving up assets across the board, and then money getting more expensive, which, what does it do? It drives assets down across the board. Again, that's why you've had a market where, typically you balance out your stock market risk by owning a bunch of bonds, right? And you say, okay, I've got my 60-40 portfolio, and I may lose money on stocks, but I'm making money on bonds. Here you have stocks that are down, you have bonds that are down, you have other assets that have been losing value, and you have pressure on things like real estate. So it's been more of this broad-based interest rate, cost of money driven bubble or boom, whatever you want to call it, and now that's being unwound.
I can see where they're coming from in the sense that the banks have behaved better this time. Like you said, we have more fixed rate financing. The mortgage origination machine is not drunk and just issuing like crazy. However, for the actual homeowner, an inflated real estate market is just an inflated real estate market. And what I think is this could possibly be worse for that person because you don't have the sort of the too big to fail reason for the giant bailout after. Like, if this thing crashes, maybe the whole thing actually gets liquidated this time the way it should have last time. Thoughts on that?
It could. I don't.
I'll let Brien jump in. Sorry.
Yeah, I think the central bank is going to do what it believes it's supposed to do, provide liquidity and kick the can further down the road. So that will happen. But, everything's different. It doesn't have to repeat like 2008. It just needs to rhyme a bit, which I think it will. Things are different now. The banks are better capitalized. They try to shore up that aspect of the system. But then they did have another real estate boom, and they are raising rates much more quickly than they ever have, really, as Mike mentioned, since the early 1980s. So that, in effect, is a much more violent application of policy, and that is going to take whatever small cracks there are in the system and widen them even more. And one aspect of today that was still bad in 2008, but is particularly bad today, is the derivative exposure of these banks. I mean, the notional value of the derivatives right now, held by all of the banks, the total does not start with a T, it starts with a Q. And I remember back in 2016 when we had Alan Greenspan speak at our conference. I had a conversation with him, and he told me that the problem today, I was trying to get him to talk about the debt and how big of an issue it was. And he said, well, that's not the biggest concern in my view. My concern is the derivative exposure of all the too big to fail banks, because now Uncle Sam essentially is backing all of that. And even the banks themselves don't know what their total exposure is. And it's enormous. That's about all we know. And all it would take is for one hiccup in one bank and one aspect of that derivative exposure to start a chain reaction that could then spread. I mean, we almost saw that in the UK just last week.
Yeah, that was actually quite surprising. Not surprised, I guess, that they came to the rescue, but it was news to me that the pension funds had that kind of leverage in long duration bonds. And I guess you knew it was there somewhere. This is a good lesson, actually, because they had kind of an impossible problem with rates being so low as how they're going to satisfy their obligations. How are they going to get the returns that they need? And I guess we know what one of the answers was to leverage up on bonds.
Yeah.
I mean, when you see interest rates do what they do, I mean, somebody somewhere is holding that exposure, right? I mean, you go back to the 1980s, and it was, a lot of S&Ls that got caught, borrowing short and lending long. You look at, other things like in the mid 1990s when it was Orange County, California that blew up when interest rates surged. This time you've got, there's UK pension obligations and problems there. We don't know exactly what's going on, but Credit Suisse has been kind of rumored out there as their investment bank having some issues, and their stock and bond prices came under a lot of pressure. So again, you never kind of know where that risk lies. You just know that somebody's holding the bag, and when you get these kinds of enormous moves, again, that's when the blow-ups start. And again, it's always sort of a different part of the market or a different type of entity that ends up in trouble. But you can't get through this kind of shift in the cost of money without somebody getting in trouble for it.
Brien, he mentions Credit Suisse, and I was a little bit surprised that we kind of circled back to that so soon, like hints of a banking crisis. But what was alarming to me was their response, because it was just so reminiscent of 2008. It was all the same. Lehman Brothers and everyone who failed had the same. We're well capitalized, we have access to liquidity, blah blah blah. The collateral is rock solid. All of that sounded so reminiscent of 2008. It was actually a little scary.
Show me one executive who stands up and says, "Yes, you're right. I do have a problem. You should withdraw your money from my institution."
Right, I mean, exactly.
I don't think anybody expects them to say that, right?
Yeah, and it's a primary indicator that there is trouble when he should have just shut up and not said anything. But, it's like Baghdad Bob. Whenever they stand up and say something, you just figure out what is 180 degrees removed from what they said. What's the exact opposite? And that's exactly what's going on.
Okay, so what do you think about this Bank of England unlimited QE? Is this the kickoff of like a brand new easing cycle that's going to spread eventually here as well?
Well, that's the hope, but that was the hope of the markets. If you notice what happened, the stock market, gold, everything took off in the U.S. because this was a hint that perhaps somewhere down the road, the Federal Reserve might also consider possibly pausing or pivoting. So all of this, very loose chain of logic and hints and innuendo was enough to send the stock market taking off. And I tweeted out at the time that imagine what happens when there really is a pivot or even just a pause, how the markets are going to react. And they're going to absolutely explode higher in a big, huge relief rally. So I think that's what we're going to have when the Fed is forced to take its collective feet off the pedal of these rate hikes. And I think that's coming up in the next month or so.
And you mentioned the Bank of England. That was an obvious catalyst, but it's worth pointing out you also had the Australian central bank that hiked rates less than expected. I believe it was a 25 basis point move instead of 50. And then right on the heels of that, you had in the U.S. the JOLTS report on job openings and all of that. Job openings plunged quite a bit. It was a pretty large move. So in the U.S., the assumption is, hey, the Fed's main worry about what's driving inflation in their mind is too much employment, right? Wages going up too much. So if you have job creation falling, you potentially get some of the other numbers like the monthly employment report. If those begin to reverse and even maybe flip into the negative, there's a strong assumption that the Fed's going to follow, the bank in Australia or the central bank in the UK and so on, and take its foot off of take the hand off the throttle, so to speak, when it comes to interest rate hikes.
And
go ahead, Brien.
Building on that, we're in that kind of a situation again. Everything is driven by what the perception is of Fed policy. So we're in a situation again where bad news is good. And, my view is that the good news is there's more bad news ahead. So, the Fed is going to have to stop either because of the cost of servicing the debt at these huge levels, at these interest rates, or they're going to break something. And we're already seeing the signs that they may break something. And I think what happened in the UK was like the tornadoes that get spun out in advance of a hurricane. You have these little dust ups here and there that are a sign that something much bigger and broader is coming up. And who knows how that's going to take shape, but I think we're going to see something like that.
That's been the sign of the times, right, Brien? The good news, what did you say? The good news is that there's bad news ahead, meaning if you want easing, you're hoping for bad news. Is that? Yeah. I think that this time the market seems to be waiting for the Fed to go back to its old ways. And I think it seems like this time the Fed has something to prove here in the sense that it was kind of embarrassed and discredited during that last big QE cycle during COVID. And it doesn't want to abandon this phase until it regains some of that back. And I think if it did it now, I don't think it would have gained any of it back. Your thoughts on that? They want to teach us a lesson that don't expect this. Don't expect me to come to the rescue every single time as soon as something goes wrong, which has been the case for many years now. Mike?
Yeah, I think that credibility is something that's built over many, many years. Your reputation can be built for years and lost in a second. It's going to take a long time for them to rebuild their credibility because they will have to give in at some point, and the markets are expecting that. Powell wants to be Volcker. He really does. But even if he has the fortitude and the determination that Volcker had, he just doesn't have the tools that Volcker had. The debt's too large now, and he cannot do what Volcker did to kill off inflation without, crashing spending in every other aspect. It's already the debt service in the federal debt is already at an annual rate of $648 billion, and that's not with the next big update coming in with third quarter GDP, which I think is going to be an astonishing number for the market. We just can't afford that. We're already spending about or more than we do on national defense just to service the federal debt. And I just don't think that's sustainable, either fiscally, practically, or politically.
And just to add to Brian's point there, again, I always go back to housing because it's an asset. Most of us own homes, or listeners that want to buy homes, viewers, and so on. I always say, okay, the last time we had inflation this high, interest rates were what in the early Volcker era? I mean, they got the Fed funds rate up to 18, 20%, long-term mortgages, 30-year mortgages cost 15, 16, 17%, whatever the number was in the early 80s. And people say, well, what's the big deal? A mortgage is 6 3/4 now. Why can't rates keep going up? And I say, okay, sure, a mortgage is 6 3/4 now, which is high. And it was 18% back then. But how much did you pay for a house back then? $80,000 bought you a pretty nice house, right? So you could afford to amortize a $60,000 or $70,000 loan at 18%. If you try and apply 18% mortgage rates now, when a nice house costs $400,000 or $500,000 or a lot more in some markets, the math just doesn't work. The payment impact would be astronomical. So you take that same principle, no pun intended, with housing, and you apply it to the government and the massive amount of debt outstanding, or you apply it to corporate America and the massive amount of debt outstanding. You just can't get interest rates as high now without breaking something as you had back then in the late 70s and early 1980s.
Yeah, that was a pretty good pun, Mike. I'd take credit for that. I think what you point to is basically what they call household affordability or home affordability, based, the house as a function of your salary. It's gone haywire long time ago, and interest rates have just covered that up. So I would argue that it's not the interest rate going up that's a problem. It's just the affordability has just gone out of line by quite a bit.
Correct.
And that implies that housing prices have to come down. I saw somebody did a calculation on Twitter, and I don't remember the exact numbers, but it was something along these lines that on a salary of, say, $150,000 at a 3% mortgage, they could afford, say, $1 million home. And at a 6.5% to 7% mortgage, that goes down to about $500,000 or $600,000. And that's the scope of the difference. So there are a lot of builders out there building $1 million homes for a market that doesn't exist anymore. What are they going to do? What's going to happen to properties? And they've got short-term loans.
I apologize. I didn't mean to speak over you there, Brien. I would just, one thing I would also add too, again, is it's not just housing. You've seen some of the markets that were driven by astronomical values for tech stocks, for example, all the wealth that was created in places like Silicon Valley and so on. That's what also, in addition to low interest rates, helped support $2, $3, $4 million townhomes and things like that, and much more in some markets. Now you have this twin factor of higher mortgage costs plus falling wealth, and especially in some of the sectors like tech that were formerly red hot that have basically crashed. Those markets that were super inflated are suffering that kind of 1-2 punch. So you're going to see some markets that get hurt very, very hard. The impact will be different again in say a Silicon Valley than it's going to be in the center of the country. But everybody's going to feel the same forces to some degree with regional variations.
I want to move on to gold now, Brien. I know you have a lot of these companies that'll be joining us next week. If you look at gold, we rallied a little bit last week. We're down this morning about 1% in response, I think, to the strong dollar. From what I've seen, it's a tight capital market, especially for tech companies, but I think for gold companies as well. I mean, I imagine it's a pretty tight market. How have the companies that you've been following been navigating this year?
The ones we're recommending in Gold Newsletter have generally done okay as far as financing. They're good companies that have been able to still attract financing, although the terms are obviously dramatically different than they would have been a year ago. I think it's getting kind of worrisome for companies because the financing window has tightened. It hasn't completely closed, but the terms are much more generous on the part of the investors as opposed to the companies. And things have to change pretty soon, or I think there's going to be some kind of cascading repercussions, especially throughout the junior mining industry. I think the producers are actually still making very good money and aren't nearly cash strapped right now. But I think something has to happen. What's interesting, though, from my point of view, we have perhaps the largest exhibitor or company participation in the New Orleans conference that we've had for many years this year. So we've sold out the exhibit hall, and it's been very gratifying, obviously, for me to see that. But it's a bit counterintuitive from what we're seeing in the broader market. So, maybe these companies are being a bit smarter. Maybe they raised enough money during the last little run-up, and they're being smarter about husbanding those resources. But they're out there talking to people, and and there are a lot of bargains out there, as we know.
Rick, I was talking with Rick Rule, and he mentioned that some of these companies were playing chicken with the capital markets, and basically now are caught in a very tough place. That could be very good for investors, no?
Yeah, good for investors, and that they can get a cheaper price. But if they've gotten in financial in a bad strap financially, it's not a very good company either. And they're going to have to raise money, and they're going to have to raise money at very dilutive levels. So if you're investing in private placements and you're confident that when things turn, the company will be able to raise money and has good prospects, then it's a good opportunity for you. But you do have to be careful. You don't want to get in a placement in a company that will not be able to raise money and keep going once things turn. And you may want to, if you're buying in the market, focus on companies that don't need to raise money. So it really depends on where you're coming from, through private placements or buying in the market. You really want to look at what a company's cash position if you're buying in the market, and hope that they don't go into a financing to raise significant funds.
Okay, final question for both of you guys. I noticed on Twitter, I think it was yesterday, Ray Dalio, I don't know if you follow him, tweeted, finally, he's changed his mind on cash. Cash is no longer trash, which I found very interesting, because it wasn't that long ago at Davos that he sort of reiterated that point, and that was just a few months ago, back in May. Cash is trash. Inflation was running over 8% at that point. The 2-year Treasury was, I think, in the twos, 2.5 roughly. So we're up from there to roughly 4. But is 1.5% enough to change cash from trash to now it's a viable asset to hold? Mike, what are your thoughts on that?
Well, I guess you could say cash has gone from being that trash that you left on the curb and forgot that it was a holiday and that the garbage company didn't come around and take, so it's been sitting there for a few days, to maybe being like the stinky recycling that's in your garage for only a couple extra days. It smells a little less bad, but it's still not doing you any favors, right? Inflation is still, the rate of inflation is still well above nominal interest rates. You're still on a real basis earning a negative return. So I always say that you've got to have some cash out there to take advantage of bargains, and I guess if you say, all right, I lost 8.5% inflation on my cash, but at least I didn't lose 30% of the NASDAQ. Okay, it's all relative, right? But until you get to these sort of positive real rates where your cash is earning more enough that it's at least keeping even with inflation, much less actually giving you a bit of return, I wouldn't say it's great. It just gives you some insurance to snap up bargains, but that's about as far as I'd go on that score.
Do you think he's expecting inflation to drop drastically, Brien? Is that why he's saying that?
That's exactly it. He has to have a view that he thinks inflation is going to come back down to, closer to that 2% mark. I think he's smart enough not to believe it's going to get to 2%, but maybe he thinks it's going to get to 4%. And maybe, loaning on that basis, loaning money to the government for 2 years at 4%, risk-free, is a viable alternative. You're not going to make any money like that, but you can always use those treasuries as collateral and then leverage up, which is what he's probably talking about there as well. But to have that view, you have to believe that your inflation is coming down. And frankly, a lot of people on Wall Street are thinking that right now. There is growing demand for treasury securities at 4% right now.
I know they claim that the monetary policy works with a lag. We certainly saw that on the way up, right? They were printing like madmen for years before we saw this inflation. But are you buying that? Do you think that they've done enough work and we just have to wait for this stuff to settle in and we'll get back down near 2?
I don't think so. I'm amazed. Oh, I'm sorry. Go ahead, Mike. You go lead off with this.
Sure. No, I think, if you look at sort of the interest rate futures market and what traders are saying about the next several months, next several Fed meetings. There's still a little more hiking that has been priced in, but it's definitely come down as a result of some of the factors we talked about earlier. But then again, those same traders were wrong a year and a half ago. So I think the market wants to believe. It's kind of like the old X-Files thing with Mulder and the poster behind his head saying, "I want to believe in aliens." Wall Street wants to believe that the Fed's going to be able to basically move to the sidelines. But if inflation doesn't cooperate, that's not going to happen. So I think this is a tentative rally based on the idea they can't go too far. Some of the forces Brien talked about earlier, in my belief, is that they cannot go very far. But could they have some more gas in the tank? I think that remains to be seen. But I can certainly sort of plot out a course where it's going to take a while for inflation to come down to levels the Fed's going to, plant its victory flag out there. So I think we may be in for some more rough air ahead.
Yeah, Albert, I'm amazed they're using that lagging factor to say everybody's saying we will have a recession or may have a recession in 2023. And I scream at the television screen whenever I see somebody say that. We're in a recession now. What are you looking at? We've had two quarters of negative growth, and everybody's just going around ignoring this. It's like the emperor has no clothes. They're not even looking at it. They're trying to redefine it. And
that's only a technical recession. It's only technical.
Yeah, technical. Not really, because the unemployment rate is so low, and that's the reason why. But the thing is, previous recessions were characterized by, no jobs. This is the first recession that was characterized by no employees. But either way, the economy is throttled by nobody in productive jobs adding wealth or growth to the economy. And everybody's sitting, not everybody, but a significant enough portion of the population is sitting on their couches in their parents' house, waiting for the parents to die so they can inherit their stock portfolio in the house. And, they may not say that, but that's basically what they're doing by sitting there and not looking at the help wanted ads. And it's enough. It's enough of the population. It's enough of a demographic, and people have been trained not to work, and they're not.
Brien, we had this conversation, I think, last time offline, and I've been thinking about it, and that is the best. It's better than my alien abduction theory of where all the employees went. I think it's the closest, and I think we're going to get a chance to test it, unfortunately, if we have a simultaneous housing crash and stock market crash. I think people are going to be looking for jobs at that point, and we'll get a chance to test that theory.
There's going to be a lot more former quote-unquote influencers that are going to have to get out there and maybe pick up a shovel, I think.
Possibly, but I don't even know if they're the problem. There's got to be other people who are, like Brien said, maybe doing nothing. Influencers at least they have to produce a lot of content, and we all know that can be a lot of work. But it's just a mystery to me where all the labor has gone. But I guess we'll see before too long. Let's wrap it up here, guys. I want to thank you both for coming on, and I'm really looking forward to seeing both of you in New Orleans. Mike, I forgot, congratulations on your new position at the Money Show. I think they made a great move bringing a guy like you on, so congratulations on that. And before we leave, the next time you guys go shirt shopping, make sure you invite me. You're hurting my feelings here.
I mean, one of those kids is not like the other, just like the Sesame Street ad or whatever.
I'm going to have to go shopping at Johnny Cash or Us or something to get some of the black shirts like you're rocking there, Albert.
All right. See you guys next week. Thanks.